Did you know that a potential return of Donald Trump to the presidency could send shockwaves through the housing market, possibly causing another crash? With recent polls showing a tight race, experts warn that his policies could trigger a sudden surge in mortgage rates and home prices, leaving millions of homeowners and buyers vulnerable. If you're trying to buy, sell, or protect your investment, understanding these risks is crucial. This video will help you navigate the uncertainties and prepare for what's coming. Make sure to hit like and subscribe so you don't miss out on vital updates. Now, let me show you why this is so urgent and what you need to know before getting started. Today, we're exploring how Donald Trump's potential return to the presidency could once again shake up the housing market. We'll analyze the possible policies and economic shift that might lead to rising mortgage rates and soaring home prices, affecting millions of homeowners and prospective buyers. This is especially relevant now, as the U.S. economy faces uncertainty with political debates and financial fluctuations, making the housing market particularly vulnerable to sudden changes. Whether you're a first-time buyer, a homeowner, or an investor, understanding these dynamics is crucial. By the end of this video, you'll have a clearer picture of the potential risks and opportunities on the horizon, along with practical insights to help you make informed decisions in this unpredictable landscape. But to make smart decisions, you first need to understand the economic landscape we're dealing with. A potential return of Donald Trump to the presidency could have significant repercussions for the U.S. housing market. Recent data from the Federal Reserve indicates that mortgage rates have already risen sharply, reaching over 7% in 2023, up from around 3% just a few years ago. This increase makes borrowing more expensive for home buyers, which can slow down housing demand and lead to falling home prices. Additionally, the Bureau of Labor Statistics reports that inflation remains elevated at around 3.7%, impacting both construction costs and consumer purchasing power. Interest rate hikes are a primary tool the Federal Reserve uses to combat inflation, but they also tighten credit conditions, making it harder for many Americans to afford homes. Meanwhile, changes in tax policies or proposed regulations under a Trump administration could further influence the market, either by incentivizing or discouraging home ownership and investment. Historically, market cycles fluctuate between periods of growth and correction, but political uncertainty adds an extra layer of volatility. All these factors, rising interest rates, persistent inflation, potential tax reforms, and economic unpredictability, create a complex environment for the housing sector. Buyers may face higher mortgage costs, while sellers could see decreased demand or declining home values. Investors need to stay informed about macroeconomic trends to navigate this landscape effectively. With that context in mind, let's break down the strategy you can actually apply. If Donald Trump returns to the presidency, it could shake up the housing market in significant ways. To understand how, let's look at the main strategy involved: how political changes can influence real estate prices and the overall market environment. When a new president takes office, especially someone with different policies, it can change things like taxes, regulations, and interest rates. These changes affect how people buy, sell, or invest in homes. For example, if new policies make borrowing more expensive, fewer people might want to take out loans to buy homes. This reduces demand, which can cause home prices to drop. Conversely, if policies become more favorable to investors or homeowners, demand might increase, pushing prices higher. This process involves a few key concepts. First, interest rates, the cost of borrowing money, play a big role. When rates go up, loans become more expensive, which can slow down the housing market. Second, tax policies can influence whether people feel encouraged or discouraged to buy or sell property. Lastly, regulations around construction and development can either make it easier or harder to build new homes, affecting supply and prices. Investors and home buyers need to watch these changes carefully. If policies shift unexpectedly, it can lead to volatility, meaning prices can swing quickly up or down. By understanding how political decisions impact interest rates, taxes, and regulations, you can better position yourself to navigate the market. Now, let's look at a real-world example to see exactly how this plays out in practice. Imagine a potential scenario where a first-time homebuyer in Texas considers purchasing a $350,000 house. With interest rates climbing above 7%, using a mortgage calculator, their monthly payment for a 30-year fixed loan would be roughly $2,450, including principal and interest. Adding estimated property taxes and insurance, the total monthly cost rises to about $3,000. If the buyer puts down 20% or $70,000, they'll need a mortgage of $280,000. Now, suppose the market remains stable or slightly declines if policies favoring investors are rolled back under a Trump administration, causing home prices to drop by 5%. That would mean the house's value could fall to around $332,500 within a year. On the flip side, if interest rates stay high or increase further, the monthly payments become less affordable, reducing demand. This could lead to a decrease in home values, especially if many buyers are priced out or choose to rent instead. If the buyer holds onto the home and the market dips, they might see their home's value decrease, while their mortgage debt stays the same. For example, if they bought at $350,000 and the market drops 5%, their home is now worth $332,500, but they still owe $280,000, potentially creating negative equity. This scenario illustrates how rising interest rates and policy shifts under a Trump presidency could lead to declining home prices and increased financial risk for buyers. This looks great, but only if you avoid the common traps that ruin deals like this. Imagine thinking you're ready to buy your dream home, only to find out later that a small mistake could cost you thousands or even derail your entire plan. As the political landscape shifts, especially with the potential return of Trump to the presidency, the housing market could face new turbulence. To protect yourself, it's crucial to avoid some common pitfalls that many buyers and investors make during uncertain times. First, neglecting to check your credit score thoroughly. A poor or fluctuating credit score can lead to higher interest rates or even denial of financing. For example, a buyer who assumed their credit was fine might face surprise hurdles when rates increase due to market volatility. Always get a detailed credit report early and work on improving it before applying for a mortgage. Second, overpaying for a property without proper due diligence. In a volatile market, rushing into a purchase without understanding the property's true value or local trends can lead to overpaying. A quick anecdote. Many investors bought homes during a boom, only to see prices drop when political or economic changes occurred, leaving them with negative equity. Third, skipping a thorough inspection or ignoring market forecasts. Overlooking these steps can cause costly surprises if prices decline or if hidden issues arise. Staying informed about market trends and conducting detailed inspections can save you from future regrets. Finally, ignoring the impact of rising interest rates on affordability. When rates climb above 7%, monthly payments become much higher, reducing your purchasing power. Planning ahead and securing the best possible financing options can keep your investment safe. To avoid those mistakes, here are the best tools and resources available right now. With the potential return of Donald Trump to the presidency, the U.S. housing market could face increased volatility, especially with interest rates soaring above 7%. To navigate this uncertain environment, it's crucial to arm yourself with the right tools. First, check your credit score regularly using platforms like Credit Karma at www.creditkarma.com. A strong credit score can help you secure better loan terms and avoid higher interest rates. Next, use real estate websites like Redfin at www.redfin.com to research market trends, property values, and neighborhood data, giving you insight into the true market conditions. For financial planning, Investopedia at www.investopedia.com offers valuable articles on mortgage options, loan calculations, and economic analysis, helping you make informed decisions. Lastly, consider using mortgage comparison tools like LendingTree at www.lendingtree.com to explore different lenders and find the best rates available in today's high-interest environment. These platforms support strategic planning, reduce surprises, and help you act confidently in a shifting market. Now that you've got the tools, let's talk about the first thing you can do today to get started. Imagine the possibility of Donald Trump returning to the presidency and how it could shake up the housing market once again. With interest rates climbing above 7%, uncertainty looms, but the key to staying ahead is taking small, manageable steps today. Start by checking your credit score on a platform like Credit Karma. Knowing your current standing isn't just about numbers. It's about unlocking better financing options and gaining confidence in your financial health. It takes only a few minutes, but it opens the door to smarter decisions down the line. Once you see your score, you can identify areas for improvement, like paying down small debts or correcting errors. These simple actions can boost your score over time, making you more attractive to lenders and better prepared for future opportunities. Building momentum begins with this first step. It's not about making huge changes overnight, but about creating a foundation, one that keeps you moving forward regardless of market volatility. Download a finance app, list your monthly expenses, or even simulate a potential mortgage or investment. Each small move ensures you're actively shaping your financial future, not just reacting to market shifts. Taking that first step is how every long-term success story begins. Let's look at what happens when you stay consistent, building confidence, making informed choices, and turning uncertainty into opportunity. The journey starts now. Imagine it's 2035. You look back and realize that your consistent, patient approach over the past decade has transformed your financial future. Despite the volatility in the housing market, especially with political shifts like Trump's potential return, remaining steady and making gradual moves allowed you to build a solid property portfolio. Perhaps today, you own 5 cash-flowing rental properties, generating steady income and appreciating in value. This wasn't achieved by chasing quick wins, but by staying disciplined, saving, investing wisely, and trusting the power of compound growth. Over time, small, regular actions compounded into significant wealth. Even if uncertainty looms, the key is consistency. By making informed decisions now, checking your credit, understanding your finances, and taking deliberate steps, you set the foundation for a future where your investments grow steadily, regardless of market swings. Remember, long-term success isn't about overnight gains, but about persistence and patience. And now that you see what's possible, here's how we wrap this up and take action. Start today with small, manageable steps. Educate yourself, stay disciplined, and let time do its magic. Because in the end, consistent effort over the years is what truly secures your financial freedom. If Trump's return to the political stage becomes a reality, it could send shockwaves through the housing market once again, causing volatility and uncertainty that many homeowners and investors need to brace for. History shows us that political shifts can influence mortgage rates, home prices, and overall market confidence. And this cycle might repeat if history repeats itself. So the key lesson? Staying informed and maintaining a disciplined approach to your finances is what will truly protect you, no matter what the headlines say. Thanks for watching and for your commitment to building a strong financial future. Remember, consistent, educated actions today lay the groundwork for long-term success. If you found this helpful, be sure to like, subscribe, and comment below. What's your first financial goal for this year? I'd love to hear from you. And if you're interested in navigating turbulent markets, check out our related video on how to invest smarter during uncertain times. Stay confident, stay focused, and keep pushing forward. Your financial freedom is within reach. See you in the next one.